If you woke up this month thinking Bitcoin was crashing back into a bear market, you're not alone. Just a few days ago, Bitcoin was sliding hard, breaking below $70,000, even dipping close to $60,000. Fear was everywhere. Social media was screaming, "It's over." But now, almost suddenly, Bitcoin is back above $70,000. So what just happened? Was that drop a trap? A fake breakdown? Or are we just getting started with something much bigger? Before we break it all down, if you care about understanding where money is really flowing and you want simple, no-hype explanations about Bitcoin and the markets, make sure you hit like and subscribe to Market Lens right now. It really helps the channel grow, and it tells me you want more deep but easy-to-understand breakdowns like this. All right, let's get into it. Bitcoin has officially reclaimed the $70,000 level after a brutal February slide that shook a lot of investors out of their positions. At the time of this recording, Bitcoin is trading a little above $70,000, up about 2% in the last 24 hours, with daily trading volume around $43 billion. That's serious activity. The total market value of Bitcoin has climbed back above $1.4 trillion. Think about that. After all that panic, we are still talking about a trillion-dollar asset class. But to really understand this move, we have to go back to the pain. Over the past couple of months, Bitcoin hasn't been smooth at all. After peaking above $120,000 back in October, it slowly started losing strength. The excitement cooled off. Momentum faded. Sellers stepped in. And what followed was a steady, grinding decline into the mid-60,000 range. Then, in early February, things escalated. Bitcoin broke below the $70,000 psychological level. That level matters because round numbers play tricks on the human mind. When 70,000 breaks, it feels like something bigger is wrong. And once that level cracked, fear spread fast. Billions in realized losses hit the market. Traders who bought higher were forced to sell. Liquidations kicked in. You could see the anxiety everywhere. Funding rates shifted. Options positioning became defensive. ETF flows weakened. It felt like people were bracing for something worse. Then something changed. And the trigger didn't come from crypto itself. It came from inflation data in the United States. The latest Consumer Price Index report showed inflation rising 2.4% year over year. That was slightly below the expected 2.5%. Now that might sound like a tiny difference, but in financial markets, small surprises can move billions of dollars. That softer-than-expected inflation number gave investors hope. Hope that the Federal Reserve might start cutting interest rates sooner than previously expected. Why does that matter for Bitcoin? Because when interest rates are high, money becomes more expensive. Investors prefer safer assets like bonds that offer stable yields. But when rate cuts come into the picture, risk appetite starts to return, and Bitcoin is considered a high beta asset. That basically means it reacts strongly when investors are willing to take risk. After that inflation report, prediction markets quickly adjusted. On platforms like Kalshi and Polymarket, the implied odds of a rate cut as early as April moved higher. Traders started betting that the Fed might ease policy sooner than expected, and when that narrative gains traction, capital starts rotating. That's exactly what we saw. Bitcoin rebounded sharply into the weekend. It climbed back above $70,000. But it wasn't just Bitcoin. Crypto-related stocks exploded higher too. Coinbase stock jumped 18% in a single day. Strategy, formerly known as MicroStrategy, surged around 10%. That kind of move shows you this wasn't random noise. Investors were rotating back into digital asset exposure. Now here's the interesting part. Coinbase recently reported a huge quarterly loss, around $666 million in Q4 2025. Trading revenue was weaker. The environment had been tough. Yet the stock still ripped higher. Why? Because markets look forward, not backward. IF investors believe rate cuts are coming, and crypto activity could pick up again. They position early. Strategy remains tightly linked to Bitcoin's volatility. The company disclosed another purchase of more than 100 Bitcoin this week. At the same time, it reported a steep quarterly loss, largely due to mark-to-market declines on its Bitcoin holdings. That highlights something important. Aggressive Bitcoin exposure can supercharge gains in bull markets, but it can also amplify pain during drawdowns. Strategy is basically a leveraged bet on Bitcoin's long-term future. So the big question is this: was that drop towards 60,000 the bottom? Research firm K33 suggested that the plunge may have marked what traders call a local bottom. They pointed to capitulation-like conditions. When markets hit capitulation, it usually means weak hands have sold. Volume spikes, funding rates get extreme, options traders become heavily defensive, ETF flows show panic outflows. It's the kind of environment where sellers exhaust themselves. But here's where we need to stay grounded. Even though Bitcoin is back above 70,000, fear hasn't completely disappeared. The Crypto Fear and Greed Index is still sitting in what's called extreme fear. The last time we saw levels like that consistently was during the 2022 bear market, when major crypto companies were collapsing. That tells us something powerful. Price has recovered, but confidence has not fully recovered. There's still caution in the air, and sometimes that's actually bullish, because major tops usually happen when everyone feels invincible, not when people are nervous. Think about the psychology here. When Bitcoin was above $120,000, optimism was everywhere. Social feeds were filled with price targets of 200,000, 300,000. But after a drop of nearly half from the peak, sentiment shifted dramatically. Now even a move back to 70,000 feels fragile. Markets move in cycles of emotion, euphoria, complacency, anxiety, fear, capitulation, then disbelief, then hope. Right now, we might be somewhere between fear and early hope. Another thing to consider is macro timing. If inflation truly continues to cool and the Federal Reserve begins cutting rates later this year, that changes liquidity conditions. Liquidity is like oxygen for risk assets. When liquidity expands, assets like Bitcoin tend to breathe easier. But nothing is guaranteed. Inflation could reaccelerate. The Fed could delay cuts. Global economic data could weaken. Geopolitical tensions could rise. Bitcoin does not move in isolation anymore. It's deeply connected to broader financial markets. The fact that daily volume is around $43 billion shows there's still massive interest. Institutions are active. ETFs have brought in a different class of investor compared to previous cycles. This market structure is not the same as 2017. It not even the same as 2021. The participants are more diverse now. At the same time, volatility remains part of Bitcoin's DNA. A drop from 120,000 to 60,000 feels dramatic. But in percentage terms, Bitcoin has done similar moves multiple times in its history. That's the cost of high upside potential. You don't get explosive rallies without sharp corrections. For long-term investors, these moments often test conviction. When price is rising fast, everyone feels smart. When price drops 30 or 40%, doubt creeps in. That's when narratives shift. Headlines turn negative. People question the entire thesis. But zooming out, Bitcoin reclaiming 70,000 after such a deep slide sends a message. The market is not dead. Demand is still there. Buyers are willing to step in when macro signals align, and let's not ignore the bigger picture. Even at $70,000, Bitcoin is significantly higher than it was just a few years ago. The long-term trend remains intact, even if the short-term path is messy. Now I want to hear from you. Do you think the 60,000 level was the real bottom, or do you believe this bounce is temporary before another leg down? Drop your thoughts in the comments, because the way this market moves next will depend heavily on macro data and investor psychology. On Market Lens, we focus on connecting these dots without hype and without fear tactics. The goal isn't to predict every tick, it's to understand the forces driving the moves. Inflation, interest rates, liquidity, sentiment, positioning. When you understand those, you stop reacting emotionally and start thinking strategically. As we move deeper into 2026, all eyes will remain on economic data. Every inflation print, every jobs report, every Federal Reserve speech will matter. Because right now, Bitcoin is trading not just on its own fundamentals, but on expectations of monetary policy. If rate cuts come sooner, risk assets could continue to recover. If they get delayed, volatility could return fast. That's the environment we're in. But here's the key takeaway. The recent drop created fear. The rebound created hope. And markets often climb a wall of worry. The fact that the fear and greed index is still in extreme fear while price has bounced could mean there's still sidelined capital waiting for confirmation. We're at a fascinating moment. Bitcoin has reclaimed 70,000, but conviction hasn't fully returned. That tension between price strength and emotional weakness is what makes this phase so interesting. If you found this breakdown helpful, make sure you share this video with someone who is confused about what's happening in crypto right now. And before you go, comment below with one word that describes how you feel about Bitcoin at this level. Confident, cautious, excited, or worried. I read the comments, and your perspective helps shape future videos here on Market Lens. Thanks for watching. Stay smart, stay patient, and I'll see you in the next one.